Welcome to this evening's webinar. I want to give everyone a few more seconds to kind of settle in. I know GoToWebinar probably looks a little different. We have upgraded to their new version. So there's a couple probably new kind of features, such as on the right-hand side, you'll still see your question section, the chat where I will share helpful links and things. And then we also have our handout, which is now called materials. So a couple little differences, but GoToWebinar got basically a facelift, so looks a little bit more modern, and so it'll take a little bit to get used to, but if you are having any issues, please feel free to email us at members@aai.com, or if it's any issues with your audio or video, you can consult the GoToWebinar website for support at gotowebinar.com. They have a lot of helpful links in case you're not hearing audio correctly, or if it's too soft, or if you're not seeing video or something like that. But this is also going to be recorded. So in case you do encounter any issues, we'll be posting the recording link, so all registrants will get access to that. So no worries if something happens, because you'll get the recording via email, and you'll be able to rewatch at your own convenience. But thank you so much for joining us. We really appreciate you attending this evening's session, and we'll begin momentarily. All right. We have a lot to cover, so I want to begin. So hello and welcome to this evening's webinar, What Global Conflict Means for Your Portfolio in 2026. Thank you so much for joining us. We're always happy to have you all here. So my name is Jenna Brashear, and I'll be your host for this evening. A few things to go over before we begin. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. If you'd like to read our full disclaimer, please visit aai.com/privacy/disclaimer. And like I said, GoToWebinar looks a little bit different tonight. So we've upgraded, and this is actually the first AAII Better Investing webinar of the year. And so we're very excited to kick things off with this event. We have two wonderful speakers tonight, Charles Rotblut from AAII and Doug Gerlach from BetterInvesting. We also have our moderator, Cynthia McLaughlin, leading the interview with Charles and Doug. I want to thank them all for being here with us this evening. Please be sure to keep an eye on the chat throughout the webinar, as we'll be sharing helpful resources throughout that is located on the right-hand side of your screen. And then if you have questions for our speakers during the presentation, please submit them using the question section of your GoToWebinar control panel located on the right-hand side of your screen. Once our presentation concludes, our moderator, Cynthia, will select a few questions for Charles and Doug to answer. And then if your question isn't selected during the broadcast, feel free to email us at members@aai.com. And if you could put somewhere in the subject line or the first part of the email body that it's about the webinar, we'll be sure to get back to you as soon as we can. And then, like I said, if you experience any issues with the audio or video of the webinar tonight, please visit gotowebinar.com. And then just a friendly reminder that this presentation is recorded, and a replay of the webinar will be sent to all who attended today. The recording and handouts will also be accessible at aai.com/webinars later this week. And in this presentation, Charles and Doug will cover a few things, such as how global crises have historically influenced markets and what lessons investors can apply today, ways to manage your retirement portfolios through periods of geopolitical uncertainty, how investor sentiment has trended during volatile periods, and then which areas of the market are potentially valuable now, including areas of rotation that we're noticing. And then, of course, we love our webinars to be interactive. So after our presentation, we'll host a live Q&A, including 2 special promos from AAII and Better Investing. So please make sure to stay for the entire broadcast. And with that, I'd like to hand over the presentation to Cynthia to kick us off.
Hello, good evening. My name is Cynthia McLaughlin, and I am from AAII. I am the Growth Investing Financial Analyst for the Growth Investing portfolio, and I'm the lead editor for the AAII Retirement Investing Service. So I'm really happy to be here, honored to be the moderator, And the way this is going to work tonight is we've selected some very key questions that we believe are top of mind for all of our investors, subscribers, and attendees. So I'm going to ask a question of Doug and Charles, and then they are going to respond with some commentary and a little bit of presentation to illustrate their points, and then we will proceed that way and have some follow-up questions. And please feel free to type any questions that you have that we'll be discussing after the main presentation in the questions section. So we look forward to all of your questions. And going ahead and getting started, Charles is up first, sharing his presentation. So we all woke up on February 28th, a Saturday morning, and it was a very different world. Just turning on the television and seeing all of the news with the war. So the Iran war has increased both geopolitical and macroeconomic uncertainties. So, does market history offer any guidance for investors? Charles, you're on mute.
There we go. Sorry about that. Thanks, Cindy. Doug, always a pleasure to be on the air with you. History, excuse me, I'm getting over a virus here, so you'll have to excuse my voice a little bit. But history does offer some clues. This chart's from the Carlson Group, and it really shows what has happened since 1900. And really, the stock market climbs worries. There's always been big concerns throughout history. We've had 2 world wars. We've had pandemics, not only obviously COVID, we also had the Spanish flu and other ones on it. We had the Arab oil embargo in the 1970s. And yet, over the long term, the stock market climbs the wall of worry. And throughout history, there's always been something going on. You can see on this chart, a bunch of things. Crash in 1929, the Six-Day War. Yet the long-term trend of the market is positive. So does it mean that history will continue as it always has in the stock market after some interruptions will stop continuing to climb? Yes. But if we ever get an event that's so bad that we see this historical trend break, it probably means something really serious happened, far more serious than we've seen in the past, and certainly more serious than we're having now. This isn't to say there aren't short-term bumps, and you can certainly see drops in this chart, but by and large, if you look at the line itself is upward sloping. The market does climb the wall of worry. The other thing I want to show you, though, is that when you look at military conflicts, the market tends to have actually risen as well. This is a chart recently published by the Leuthold Group looking at various military conflicts since World War II. If you look at that far right column, that's 12 months after the military event has occurred. If you notice, most of the numbers in that column are positive. There are a few negative ones. 2 that I highlighted, one is Yom Kippur War. You go back to that, you do have the Arab oil embargo then. You had President Nixon taking us off the gold standard. You had price controls. So several things were going on besides the oil embargo. And certainly the oil embargo was really bad for the U.S. and it's somewhat apropos now that we have what's going with the Strait of Hormuz being blocked. But that was a bad scenario. And then when you look there at really September 11th, they split September 11th in an invasion of Afghanistan. It was really one thing. And that actually occurred in the aftermath of the dot-com bubble bursting. So we had an economy that was still on its heels from the dot-com bubble crashing, the market pulling back, and then obviously we had the terrorist attack and the resulting conflict in Afghanistan where we wanted to go after bin Laden. So 2 situations there. In both cases, you had military conflicts, but you also had other events happening. But if you look at the bottom, you do see the average for all events has really been positive. Um, it is less in all periods, but we do tend to go through things. And typically with war, it tends to actually end up being a positive for the economy because it means we have to ramp up production, ramp up factory work. But obviously, every war is different. And obviously, we are concerned about this Middle East conflict potentially spreading more, and it is disrupting oil right now. But again, there's always that fear of unknown, and investors have to realize you have to look past the headlines and be prepared to understand that history, while it often does not repeat, it does rhyme, and the rhyming part suggests there is a reason to be patient with your portfolio. Doug, do you want to chime in with your thoughts?
I think we are looking at the market from a similar perspective. I have a couple of examples of perhaps some different confluence of events and different perspectives that kind of reach the same perspective, the same conclusion that you presented. I did think this quote from Philip Fisher in Common Stocks and Uncommon Profits was very apropos. Don't be afraid of buying on a war scare. And this is from 1958 from probably most of you are familiar with Philip Fisher and his seminal work on investing coming out of the stock market crash of 29 and some very terrible bear markets, but he lived through the greatest wars, World War I, World War II, and saw the impact that they had on the U.S. markets. And his point was nothing to panic over, to be certain, and maybe there are opportunities here. This is another graph that looks at the largest one-day market moves since 1940. The red stripes there are down days. The green stripes are up days, and you can see often those the red downturns correlate with military action or the commencement of a war or conflict somewhere around the globe, while the green bars, there's a whole raft of them around 2008, when the housing financial markets broke down and the bubble burst. And so we saw a lot of volatility, certainly, and a lot of upticks. But for by and large, the conclusion is that war doesn't move markets. Other events do move markets. You look at this history of the worst bear markets in history I've highlighted so this is the 19 of the worst bear markets in history, and I've highlighted in the red text any that are related to wars or military action. And Charles mentioned this sort of confluence of events that for instance, when you look at the bear market from 1972, the events that triggered it, inflation, Vietnam, and Watergate. Well, one of those is a military action, extended military action. Two of them have nothing to do with that. The same thing with, World War One, the bear market related to World War One, and the influenza pandemic, the global Spanish flu pandemic that decimated many sections. Same thing with following the Great Depression, and perhaps the World War II was a contributing factor to lifting the country out of the economic malaise that followed the Depression and long periods in the 30s where the country was trying to find its economic footing. As you scroll down this chart, you'll see certainly into 2021 what we recall now, the conflict in the Ukraine, but that was accompanied by spiking inflation here in the U.S. and the supply chain issues and shortages of products, and that were impacting all sorts of manufacturers and service providers. So again, it's not just the military action that makes investors nervous, and so I think that this history should be a little reassuring that even if we are at the start of an extended military conflict, that there will be, it will not be decimating to the overall market. It's been described that wars are not market problems, but money problems. And we perhaps maybe seen the start of that in that when the U.S. engages in military conflicts, the spending goes up. That benefits a lot of companies as well, that boosts the economy in many respects. However, because the government needs to raise that money, they need to borrow it, and so we have puts the overall financial footing of the country in a particular place that's not always advantageous to other participants in the economy. So I think that by and large, certainly panic is not the answer, and I would argue that sitting tight is probably the best course of action at this point.
Okay. That was great. I feel like we just received a little history of the market, also kind of a little financial history book lesson. Thank you. So, the blockage of the Strait of Hormuz and attacks on the energy infrastructure sent oil prices above $100 per barrel this month. What reaction have you seen in oil stocks?
Charles, you want to go ahead? You got to unmute.
Sorry, I was coughing. I muted myself because I was coughing. So I shared this chart actually last week with AI members, and so it's simple. I plotted the iShares U.S. Energy ETF, IYE, that tracks oil stocks, Chevron, Exxon, some oil service companies, and I plotted against the USO, which is the United States Oil ETF. The USO, not the military USO, this USO, the ETF, this tracks light sweet crude in the US. And as you can see from the charts, oil prices have gone up far more than we've seen oil stocks. Now, granted, oil prices have been a little bit volatile given the events of this over the weekend. I did not update it through today, I updated through Friday. What you're seeing here, but you are seeing oil prices jump a lot more. And there's a couple things to realize. Oil prices themselves are extremely volatile because it's easy for traders to move oil prices back and forth. But if you're an oil company, it's not easy to necessarily ramp up production. And in fact, oil companies tend to be slower in terms of ramping up production because it does take a lot of logistics, a lot of money. And so you want to be certain that oil is actually going to remain at a certain price. And right now, if you look at natural gas, the United States is a net exporter of natural gas, but because of logistical constraints, we can't actually export more gas right now as well. So if you're a natural gas company, you're not necessarily profiting on what's happening internationally if you're in the US because you just can't get extra natural gas out of it. And so I think it's important to realize that we are seeing oil service and oil related stocks going up, but you're not seeing that volatility you're seeing in oil as a result. But it is worth noting that oil stocks were actually doing well before this, before we actually had this war break out. And maybe part of that was, we had chat about the war, about what's going on. But I think investors who are wanting to actually play off the energy prices, my suggestion for you is to look at the oil stocks, look at the valuations. And the key to really making money in oil is if either you're a momentum trader and you're doing the momentum, or you're looking to buy the oil companies on the cheap and then profit when their prices rise. Trying to actually buy oil stocks just because their prices rose, unless you're using a momentum technical analysis type strategy, isn't necessarily a winning strategy. You really want to make sure that there's a long-term fundamental reason to make that the stock's attractive, and that means considering the stock's valuation. Doug, do you have some thoughts you'd like to share?
Yeah, I think that you've nailed it, and I like your characterization of how oil companies make money, and certainly it's something that maybe is a little counterintuitive. But as oil prices go up, energy stocks see their margins go up. They're able to push their prices upward and become more profitable. I took a look at a couple of the energy sector stocks in our dividend informer. So these are stocks that are not, they're not necessarily high yielders, but they are companies that have a good sound foundation to pay out dividends, and they generally, these companies have lower betas, and our dividend approach, I think it's similar to yours, Charles, is very much about managing volatility, and not seeking, high yielding, which we would perceive as being riskier, but getting that good dividend growth characteristics on top of the fundamentals and buying at advantageous valuations. And so I looked at a couple of those companies. Uh, and certainly upstream companies will expand, see their margins going up. And the history of military skirmishes, especially if they're short-lived, see a spike in oil prices and a subsequent fade. And we would imagine it takes some time for the levels and the supply and demand to kind of equalize. And that's something to look forward to as the energy companies are navigating this. I had three companies that I just wanted to pull out since March 2nd. This is Coterra Energy. You can see up 7% in a couple of weeks. So investors not looking at this company particularly worried about it. This is Marathon Oil. So here we have, midstream refiner, broad-based oil company up 10.8% in that same period. And then we also cover Oniak, who's a midstream provider. And so, again, up 4.4%. Maybe not all of these are directly related to oil production, but they are in the energy sector, and they're going to be impacted by perceptions of investors on how energy stocks are likely to perform. As Charles would say, I'm not suggesting we go out and buy these stocks right now, but it is interesting to see these companies holding their own. And so energy, a lot of investors hold energy stocks, good diversification hedge. They're not always good growth or capital appreciation prospects in a portfolio, but they do pay yields. And I would perceive that these are going to continue to perform well. And again, as Charles pointed out earlier, given what we know about how things tend to transpire, if we have a confluence of events where everything goes south all at once, well, then all bets are off. But what we know from the history and the patterns and the trends tells us that, yeah, this is what we would expect to see. And the and then the sideline on this is what happens to other companies as a result of rising energy costs is a key input. Airlines, for instance, notoriously are fall subject to rising jet fuel prices and may or may not hedge, and so they can get hit pretty hard. Cruise ship operators, remember, the surcharges that travel providers put on for the convenience fee of providing you with travel and transportation in an era of rising fuel prices. So other staples, even like bakeries and house and foods, defensive companies that provide food services and grocery stores get their margins pressured when oil prices go up, because transportation is such a big cost of their businesses. So, but again, I think there's going to be a little bit of a delay in when those start showing up, and we'll expect to see and hear about rising energy costs, rising fuel costs in corporate earnings for this quarter, and companies divulging how sensitive they are, how much it's impacting their business. So that is something to be aware of. I don't think it's something that we need to immediately pivot into or out of energy stocks, and those plays get very complicated very quickly. And I think you're fine if you're holding these stocks. Reap the rewards now, and you don't need to change course in the middle of all that's going on. All right, Cynthia, I'll turn it over to you.
Okay. In terms of investor sentiment, how have investors reacted to all of this? Charles, do you want to start off?
Sorry, yeah, absolutely. I'll share my screen here. So we do a weekly sentiment survey of our members. Uh, each week we ask them, do they think the market's going to go up, bullish, go down, bearish, or remain be approximately flat, which is neutral. As you can see in this chart, we did not see much of a reaction that first week after the bombing started. And that's really that vertical line you see near the right of the slide. But then over the past 2 weeks, we've actually have seen a shift on here. And you notice, and this chart is from our AAII Sentiment Investing website. As you see, what happened was not so much that bullish went down, but we really saw a shift. The people who are neutral, kind of expecting the markets to be flat, that plunged 31.4% to 17.6%. And we saw bearish sentiment, expectations that stock market's going to fall over the next 6 months. That jumped from 35.5% to 52%. To put those numbers in perspective, average from bearish sentiment's about 31%. Neutral's about the same. Actually, average for bearish is 30. Average for bullish is about 31%. So we are seeing neutral sentiment at an unusually low level, bear sentiment at an unusually high level. And we did 2 weeks ago ask our members, as part of the sentiment survey, we asked an additional question, how they felt about the Iran war and how to expect it, how that's impacting their short-term outlook for stocks. Slightly more than 70% described this conflict as either a reason to be a little more cautious or a reason to be to be bearish about stocks. Now, obviously, headlines are changing almost daily on this. We'll see what our next survey says. That'll be out Thursday morning, and we'll see how investors are responding to it. But I will point out what we see, and Doug, you can comment what you see on the Better Investing membership as well. We tend to see sentiment among AAII members. We tend to see sentiment being much more volatile than what they actually do with their portfolios. So they respond with emotion to our survey, but when we look at our asset allocation survey, they're smart enough and prudent enough not to let those emotions drive their investing decisions. So invest more long term, but we're human and we tend to be reactive, and we see that in terms of how people vote in our sentiment survey. Doug, I'd love to hear your insights.
We have a survey as well. For those of you who don't know, we support investment clubs, and we have a program, an application for investment club operations and accounting. And so we have, on an ongoing basis, we ask club members to tell us are they bullish, are they bearish, are they neutral over the next 12 months. So we have a sentiment index just for these investment club members. So you can see the graph here going back to 2015 roughly. And on the top is the bullish in red. The bottom is the bullish in green, the bearish in red, the gray is the neutral. There's a dotted line that shows the S&P 500 forward 12-month performance. And the key takeaway is, for instance, in 2020, when you see the bearish in the center of the screen, when you see the bearish sentiment go down, you'll see the forward 12-month performance goes up. So it's the opposite. When everyone is really bearish, that's probably the best time to be investing in the stock market. When everyone is really bullish, that's probably when you want to step back. And right now, we saw the same thing. Our neutral sentiment for the month of March so far is about the same as it was for February, but the bullish sentiment did go down from 49% to 35%. So that's just telling us that people are worried. My counsel to our investors and club members is you should be aware of what's going on in the markets, in the economy, in the global geopolitical sphere. But that doesn't mean that you have to act just because of particular trends or particular events that are going on. We'll talk about time frame as well. We have a big, our approach is long-term based. We have a unified stock analysis approach that we that we teach our clubs and most of them use. And that is a risk management technique to look beyond. I don't think anyone is predicting that this Middle East conflict is going to go on for 5 years or 8 years or 10 years, or everyone is banking on a quick resolution, for which may or may not be the case, but that's certainly the perception that's built in, and why so much of the market, I think, is looking at this and saying, shrugging it off, right? Or they don't believe that the presidential administration is really going to carry through on any sort of long-term military initiative. And so, again, you can go down this rabbit hole where we're trying to figure out what other investors are thinking so that we can make decisions about what we want to. And at the end of the day, there's being over analytical doesn't get you anything. Focusing on what you can predict, which, as both Charles and I, have the charts of the long-term upward resilience of the market. If you bank on that, I think it seems logical to me. It makes sense. And there are questions for retirees. I get it if you're near retiring or if you're in retirement, but that's a question about portfolio design. I don't think it's a question about tactics and strategy at this point, if you're in that situation. So very close, similar in the sentiment, I think. But as with assessments of individual investor risk, what people say and what they do often doesn't match, and perhaps that is something to to consider as you're reviewing this information. Of course, the AAII sentiment survey has been going on for decades and decades, so there's lots of data there, and lots of reactions to the market. And at the end of the day, if you are focused on quality as opposed to scraping the bottom of the barrel with your equity selection, you're going to be in a much better place.
Oh, thank you. So we talked a little bit about those nearing retirement or living in retirement, and how that group of people are really fearful about the impact of this geopolitical uncertainty on their portfolios. Is there any specific guidance or way that you would recommend people digest this information? I know a lot of investors are used to watching their portfolios rise over the past few years, especially. And I think a lot of people are experiencing a bit of a dip for the first time. So I'll put that out there for both of you to respond. Thank you.
Yeah, I'll go first. Our our founder James Clunan had what he called the level 3 withdrawal strategy, and I have it in front of me. I know there's a lot of numbers. I'll walk you through it. At a high level, it's really about just having a safety valve. So particularly if you're in retirement or you're nearing retirement and you need to withdraw money out of your portfolio, the basic idea is have a cash bucket, have a set of defensive assets so you're not selling stocks when the market's down. And the reason why you want to try and avoid selling stocks whenever the market's down, and it's not really down yet, despite all the volatility. We're off the highs, but we're not, really in a market correction yet. But the reason you don't want to sell when you're in a correction or a bear market is you're locking in your losses. So if you need money out of your portfolio and you have a set of defensive assets, it can be cash, it can be money market accounts, it can be short-term bonds. The idea is that you have that safety valve and you withdraw from that. So you give your growth assets, meaning your equities, and perhaps you have REITs, give those a chance to rebound. What James Clunan recommended, what you see here, two parts, is as you're approaching retirement over the really starting 4 years out, start refilling your bucket. Put in equal amounts. In this case, we say you need, 4 years of expenses, you need $200,000 in your portfolio. Nice round number. So we assume every year you're going to put $50,000 in. Now, if during that 4 years the market goes down, hold putting on withdrawals, just let your money kind of build up. And then once the market rebounds, try to recap so you get to your retirement date with that $200,000. Now, once you're in a star retirement, in that case, you start withdrawing. You withdraw from your equities whenever the market's up, whenever the market drops. In that scenario, then you actually tap your safe assets, giving your portfolio a way to actually come back. And so a very simple way of thinking about this is really it's a lot of you might have heard of a bucket strategy. This is basically a two bucket strategy. You have your growth assets and you have your defensive assets. Most of the time, you're withdrawing from your growth assets, but when the market's down, including use a measure of 5% below the market high, then you tap your defensive assets. So you give your growth assets a chance to come back. Now, if you're in your working years, you want to think about perhaps having emergency savings. What happens if something happens to your job? At least you have the protection. You're not having to pull from your 401k to while you're in that in between transition period. So again, it's that same type of notion about just having that safety valve. And for those people who are just nervous about the market, sometimes having a little extra allocated to bonds or cash, although financially you can make the argument it's not ideal, if having that little bit more of safety bucket allows you to stay in stocks, then it's well worth it for you, because at the end of the day, the most effective, or really the best investment strategy for you is the one that allows you to stay invested no matter what the market's doing. And that optimal strategy, what that perfect allocation is, varies for each person. I'll add one other thing though. If you're retired and you get all your living expenses from annuities, from pensions in that situation, and you have the tolerance to do it, you can have a mostly stock portfolio, because in that case, you really don't need to take withdrawals. And a lot of brokers allow you to do your RMDs with actual shares of stock, so you never have to sell stocks. But in that scenario, it really comes down to what is your emotional and psychological tolerance to deal with market downturns. I'll let Doug chime in.
Yeah, I'm struck. I recently saw a video of some young 20-somethings who were confronted with a boombox, a cassette player and an audio cassette, and they had to figure it out, and they struggled. And I'm sure that most of us here in the webinar tonight understand how an audio cassette tape works, and know how to push the buttons to eject it and start it and rewind. But the point is that we often forget. Many investors, don't recall the last time we had a major bear market in the United States, and the ones that we've had, 2020 was a blip. 2008 was supposed to be the Great Recession, and it resolved itself relatively quickly. The dot-com bubble bursting in 2001 was painful, and lessons were learned for sure. And then we're back, Black Monday in 1987. And so that's ancient history for a lot of investors. Better Investing's approach has always been about having a 5-year horizon, and many of our members go into retirement 100% invested in equities. We have there are ways you can downshift. The bucket strategy is I think is very valid. We approach it from a slightly different perspective, where you have a core portfolio, and perhaps instead of seeking that full-on capital appreciation, you'll mix in some more dividend growth approach. But I still hear the 60-40 stock bond portfolio allocation be recommended, and I just think this is an artifact of the 1970s, I think, or the 80s. The last time a 60-40 stock bond allocation was truly effective. It was certainly the market dynamics of the last really 2 decades, supply and demand, and the growth of mega cap and index investing is really pushing the market along in ways that we haven't seen before. So managing risk is always going to be an element that each individual is going to have to figure out how it works. And if you're a retiree or a near retiree, nobody goes into retirement saying, well, my plan is that everything is just going to go great, and if it doesn't, I'll just dump my stocks at the bottom and see what happens then, which is obviously behavioral, and it's what happens, but nobody goes into their retirement phase and says, says that this is how they're going to approach risk management and return and ensuring they've got enough capital to outlive their needs for it. So I think that those are really key elements. I would also say that the big risk is getting out of the market. Selling high, buying higher is just no way to profit in the market to build wealth, and that's one of the key elements in moving to the sidelines. I refer to uh, the portfolio design aspect of constantly monitoring the risk and return aspects of your portfolio is making micro adjustments. We don't talk about pivoting to one sector. We don't talk about sector rotation. We don't talk about tactics that are driven by market momentum and that influence your decisions. Having said that, yes, you can make micro adjustments when necessary, when you're feeling nervous. If it helps you to be a little more confident, to switch up some of your portfolio allocation, then I think that's something to be explored, and you shouldn't feel badly about that. Our other One of our other overriding principles is that often the sectors and industries that are cheap, uh, that everyone else hates, is the signal for you to get in. As it's the Warren Buffett, be fearful when others are greedy and greedy when others are fearful. And I take that approach to heart. I think that that's a great way to approach the market. And when you wake up and you see bad news, maybe your first response should be, where are the opportunities? And there are opportunities, and there are companies that are performing well. We'll talk about, dividend stocks. I think there are opportunities there. Small cap, certainly in this market of 2026, I think there are still opportunities there. So there's plenty for us to talk about. Cynthia, I'll turn it back to you.
Hey. Oh, thank you. Those are wonderful perspectives. So even before the Iran war started, we've seen changes in the types of stocks that investors prefer or favor. Are there any particular trends that either of you have noticed since the beginning of this year?
Sure, I'll go first. Yeah, so I put together this chart actually here, and this is really showing what we saw before the war started and then afterwards. So before the war started, we saw dividend stocks doing really well. We saw small cap stocks doing really well. Notably, energy stocks were actually doing well. And I mentioned this earlier. It's hard to parse from this how much of that was actually the run up to the war beforehand, but we saw those things doing really well. But we did see at the start of the war this rotation really out of the large cap growth stocks that have done so well into other areas of the market that hadn't done so well. And gold still had some momentum as well. And we also saw foreign stocks doing really well. And the foreign stocks is interesting because we have seen valuations for foreign stocks really be below US stocks. And when you look at how foreign stocks have performed relative to US stocks over the long term, foreign stocks have actually gone over an unusually long period of underperformance relative to US stocks. But after that February 27th, which was the last day really when the market before the war started, you see the switch where you actually see in that right-hand column, you see the S&P 500 actually holding up better than these other categories. It's still lost, but still dropped better. Oil stocks obviously did well. I showed you the chart earlier, but you can look at this where you've seen now dividend stocks lagging, value stocks lagging. You're seeing foreign stocks lagging. And interestingly, gold, which is traditionally a safe haven and has done really well leading up to the war, has dropped. Now, I can't explain why gold has dropped other than perhaps commodity-oriented investors are switching to oil over gold. But I just happened to notice and thought that was interesting. So we are seeing this rotation going on because of the war. Now, after the war, do we see a rotation back? Hard to say, but I will point out, going into this year, dividend stocks were undervalued, small cap value stocks were undervalued, and here we see this particularly with our model shadow stock portfolio. We're seeing those very small stocks being very undervalued, opportunities for investors. And so we do at some point expect that pendulum to kind of swing back towards those asset classes, but trying to predict when the pendulum's going to move and how quickly it's going to move is hard to say, because the market can remain way off of historical means for an extended period of time, and certainly longer than people have the patience to wait it out. But when you do have those swings, they're pretty big, as you see here, like for instance with dividend stocks really outperforming the S&P 500, which is driven by those growth stocks by a wide amount until the war occurred. Doug, what have you noticed?
Well, I certainly agree with so many of your comments there. When we look at dividend stocks, our dividend newsletter year to date is just knocking it out of the park. And that, I think, is part and parcel of one our approach. We are not we're not indexing. We're holding. This is 50 well chosen, we think, high quality stocks. But this is out smashing the dividend aristocrats and the S&P 500 through yesterday. That compound annual rate of return. So I think that makes sense, right? Even in the last week or so, a couple of weeks, we see investors maybe switching up a little bit, looking at these as opposed to some of the more speculative mega caps or overvalued, hypervalued securities. Yes, and I'm the small cap guy, and so the small cap market has been terrific. For us last year, our selections outperformed the S&P 500, even though the S&P 600 trailed. When we look at small caps, right now, small caps are still undervalued, in my view, according to the S&P 500. And I think there are plenty of opportunities for those companies going forward. One advantage of small company analysis is that you can figure out the impact of energy costs and energy prices and supply chain issues. Perhaps they're a little more transparent than with larger companies, where it's just one more item in a giant pool of expenses that they have to navigate. But I definitely see the small cap opportunities in small cap markets. And interestingly, two of my favorite stocks right now that we focused on in our small cap newsletter earlier this year are farm agricultural companies. One is Farmer Mac, and one is Vital Farms, which is a high-end egg producer. And both of them, I think, were undervalued when we started profiling them. And they're still, Vital Farms broke a little bit to the downside, and Farmer Mac is still out there. I think there's a little contrarianism built into it, but those companies, are purely domestic. They're plays on the U.S., the growth of the U.S. economy, and the strength of rural America. And I think that those remain just as vibrant opportunities now as they were before the war started.
Okay, we will now move to our final question before we entertain audience questions. And the valuations of the S&P 500 were high before the Iran war started. Where can investors look to find value?
Sure, absolutely. I'll go first. So one of the things, Doug just talked about small cap stocks. I do think that's definitely a place to go looking for it. And I mentioned it too. This is for our shadow stock portfolio. We run this chart quite a bit. The shadow stock portfolio looks for the smallest 10% of stocks by market capitalization and the cheapest 10% of stocks by price to book. So Eugene Fama, Ken French, two very famous professors. Fama actually is a Nobel Prize laureate as well, Nobel laureate. Found if you by that intersection, you actually have outperformance. The term shadow stocks really refers to the fact that these stocks exist in the shadows of Wall Street. Because they're so small, most institutional investors cannot touch them, which makes them more inefficiently priced, which is really professional finance speak for saying they tend to be undervalued because not as many people are looking at them. But what you see here in this chart, it's really that red line is where you're looking at the S&P small cap 600 is valued at on a price to PE basis. That black horizontal line is really the average relationship of the S&P small cap 600 relative to the S&P 500. As you can see, small cap stocks are really undervalued. And so I definitely think there's opportunities there for investors in terms of numbers for people who like hard numbers. The median PE of S&P 500 stocks, so not what the S&P 500 is actually trading at, but the median PE for all 500 stocks is 24.6. For the S&P small cap 600, the median PE is 19.3. So, more than a 5-point difference in valuation. We see that on a price to book ratio is all a huge difference in valuation. So, people looking for bargains, small caps, they're definitely there. And you do have to be picky. We definitely want your small cap companies to be profitable. You want them to have fundamentally sound business when you look at it. So don't just look for small size. Make sure the fundamental strength is there as well. The other thing, and Doug was just talking about dividend stocks and the performance of their dividend newsletter. I'm the editor of our dividend investing newsletter. We've also seen dividend stocks doing really well this year. Even now, even with dividend stocks underperforming this month, year to date, our dividend investing portfolios continue to beat the broad market. So we do see value among dividend stocks. Our model portfolio yields 2.4%. We follow a dividend growth strategy. The iShares Dow Jones IYY, as you can see here, broad market index has a 1% yield. One thing I'll point out for you is when you're looking for yield, you look at relative yield, realize the yield for the market overall is really low. So if you're going into this thinking, well, I want a high yield, I want a 5% yielding stock, you might find some, but by and large, what's a high relative yield now is still lower in absolute level, but there are still many attractive dividend stocks. And as Doug pointed out, as I said, they did outperform since the start of the year till now. Obviously, a little bit of shift here, but I would say investors are looking for areas to invest. Dividend stocks, you can find some very fundamentally sound stocks trading at attractive valuations that have a history of growing dividends, which means you get the attractive yield now and you actually continue getting more payments going on because those dividend growth stocks will continuously raise their dividends. And so we think those are attractive stocks in this market. And I think it's a good strategy, particularly for income investors who want to look for value and actually have stocks with attractive fundamental traits as well. Doug, I guess what's piquing your interest?
Yeah, well, I would agree. I don't have any more slides to show, but I like we're so aligned in terms of the dividend approach. Our dividend newsletter is only a couple of years old, so it's taken some time for our picks to start to show that performance. But we've definitely received when we launched. We would highlight a stock with a 2.5% dividend yield, and got nasty emails saying that's not a yield. Well, that's much better than the broader market. That's an above average yield. And if you're looking by industry group, that could be totally respectable. You're not going to beat the market on a 2.5% yield, but as that dividend grows, as the capital appreciation kicks in, if you're able to buy when valuations are low, then you can get a reasonable rate of return without the volatility that a lot of investors don't want. I think the average beta of our dividend stocks is 0.8, and so that's pretty low. So for every point the S&P 500 moves, ours would go up 0.8. But on the downside, if the market goes down 10 points, ours would go down 8 points. So we think that's a good place to be for a certain type of investor. If you're nervous about, and of course, it doesn't do you any good right now if you say, oh, well, that makes a lot of sense. Maybe that's what I should have done. Now's not the time to make the switch in this era of, or this period of greater uncertainty. It's like insurance. You buy house insurance well before you need it. You don't go shopping once the fire starts. So portfolio design, in my view, is very similar. And so if you are just assembling a grab bag of stock picks and wondering why you have so much volatility or your returns are not what you expect, portfolio design, I think, goes a long way towards solving that particular problem. And yeah, so there are a lot of great dividend stock opportunities. There are a lot of great small cap opportunities. Charles, you pointed out the small cap, and again, technically, I think the Russell 2000 is in correction territory. It's down more than 10%, or it had gone down more than 10%. I consider the Russell 2000 a fake small cap index because they're not really small companies. They're larger and are so I like the S&P 600, small cap 600 as that target benchmark for small cap performance, but also it's the value aspect of small caps that make them most attractive right now. You can go after Kava Group and see with multiples in the approaching 100, all sorts of volatility built into a stock like that, but these companies like Vital Farms or Farmer Mac that I mentioned, have PEs in the teens and growth in the mid-teens to perhaps even more, the high teens. So that type of valuation mismatch we've learned can go on for a very, very, very long time, but ultimately it's got to coalesce and come together and deliver returns. And when it does, then you really see the performance of small caps move to the forefront. And I think that everybody should have a little bit of exposure to small company stocks in their portfolio.
A question is, what are your thoughts on international stocks?
I just talked about this earlier. I think they have a place in a portfolio, not only for diversification, but I do think relative to the U.S., they're undervalued. I think there's an opportunity to pick up some good stocks. I personally own an international ETF, actually a mutual fund as well. I do think it's a good way to get exposure to those foreign markets. There's certainly international stocks that do trade here in the U.S. either as ADRs on the broad market. I'll also point out you do have some big companies that trade also on the over-the-counter markets. I own Louis Vuitton. They're an over-the-counter stock, and so you can actually buy those shares there. I think for a lot of people, though, particularly for emerging markets, ETFs or index funds are a good way to go because you can get exposure directly to those local markets. But again, foreign markets don't always move with the U.S. What we tend to see is over the long term, they tend to be uncorrelated. But when there's a global crisis and the markets are going down, those correlations shoot right up and you do tend to see everything fall down along with it. So I will add that caveat to it.
Yeah, 20 years ago plus now, I co-wrote a book called The Armchair Millionaire, and we talked about an investing strategy that was built around index funds or ETFs, where you essentially just split your assets into thirds: a third in large caps, the S&P 500, a third in small caps, in the Russell or the S&P 600, and a third in EFA, the Europe, Australasia, Far East index. And that is essentially a large cap, non-US developed markets index. And so I track those three market segments. I think that gives us a lot of information about what's happening around the world. The emerging market segment is something that, you can add into that if you want, a broad emerging markets ETF. But we've until 2025, that EFA index was on a 10 plus year of underperformance relative to US markets. And so many international investors are buying US equities because of the strength and stability they perceive in those opportunities. But and the other point that I like to remind investors is that in any given year, 40 to 50% of the sales and earnings of S&P 500 companies come from outside the United States. So you're probably already getting international exposure, and you can, a good experiment is to try to look at your individual equities and figure out what percentage of their sales and earnings come from outside the United States. And then you can figure out what your international exposure is. And for many investors, they might be surprised to discover just how much foreign stock positions they have within their US company portfolio. And the advantage of that is you don't have to worry about currency conversion. The company worries about it. You don't have to worry about headwinds and tailwinds internationally. You're going to let the company manage. And if it's a well-managed business, they're going to do a better job of it than you're going to do trying to figure out your portfolio of non-US companies. Certainly ETFs are strong if you've got conviction about a particular region of the world. A broad-based ETF in that region would be a great opportunity. I don't think it's necessarily part of your core portfolio, but if you are so inclined and have special expertise or knowledge, then I think it's a perfectly viable way to reap some awards from what's going on outside the United States. So much of the time, we've got our blinders on in the U.S. We don't see what's going on unless it raises to the level of headlines, and then those headlines are almost always negative, and so it's easy to write off the rest of the world. But there are a lot of economies that are blooming and doing well, and they're often not as correlated with what's going on in the United States. However, in the last 20 years, I think we've seen the correlation between the EFA and the S&P 500 converge a little bit. It used to be that they were very non-correlated, and the same thing with small caps and large caps in the U.S. The returns have come together a little bit. But still, as part of a well-designed portfolio, having that exposure, I think, is still advantageous.
So kind of pivoting back to the beginning of the presentation tonight, we have a question about what is the average length of the recovery period after a major decline? Is it several years? Is it months? What information can you share about that?
It depends what you're looking at. Sam Sovels of CFRA has published some great stuff. He's spoken at AI events. I know he's spoken at BI events as well. If you're looking at a mega meltdown, say like a 2008, you're looking about up to 3 to 4 years of recovery. If by a typical bear market, probably about a year actually, it recovers fairly quickly from like we had in 2022, a garden variety bear market, which is a decline of 20 to 30%, which is most bear markets. So he has a saying that the market likes to take the elevator down and then the staircase up. That's pretty much how it is. But for most cases, you will see the market recover pretty quickly, and often certain areas of the market rebound much quicker. If you look at 2008, small cap stocks, our mild shadow stock portfolio had a really rough 2008, 2009. I think it was up about 50%. It just skyrocketed. So the market can move fast. And I think in this scenario, if you see the market dropping, you think you're going to get out, don't think you're going to know when to get in, because the market will turn on a dime and it will move quickly. And often you start seeing the gains well before people start feeling comfortable to feel comfortable with stocks. You start seeing a lot of those gains occur. And very often the biggest gains in the market are very closely correlated to the biggest drops in the market. So it's impossible to predict those. Certainly, you can look at my NCAA bracket right now. No, I do not have good prediction skills.
Sorry, hitting the wrong buttons here. I have in my slides, you'll see the worst bear markets here, and it's got the percentage decline, the peak, the date of the peak, the date of the trough, and then the total, the period at which until the bear market ended. So you can see. You have to do some, addition, but you can figure out the length of these, and certainly the most recent events. We talked about the COVID bear market, which was 6 months, 7 months. We're going to consider the outbreak of the Boer War in 1897 as an outlier at this point. It's not very relevant, but as we look at the .com. It was bear market that was triggered, that the peak in August 2000. The trough was 8 years later in 2009. Full recovery didn't come until 2013. We had the global financial crisis in between there that exacerbated things. But the December 2021 bear market was over in less than about 2.5 years. So that 2 to 3 year period is pretty average, but some of them can go on much longer, and some of them resolve much more quickly. And so I think it's probably one of the least useful bits of knowledge to have the specifics of the lengths of bear markets, because they're all over the map. Again, we come back to the confluence of circumstances that led to this particular state of affairs is never duplicated, right? And it's the same thing with the economy right now. There, you can look at every single one of the indicators and say if it's bullish or bearish, and you put them all in a pot, and what comes out at the end is completely unpredictable, because we've never had this particular set of indicators at these particular levels all at this particular period of time. And so I think the takeaway for bear markets is that you're not going to get an invitation. You're not going to get an announcement that it's going to end. It's going to be a surprise to everybody. If it wasn't a surprise, it wouldn't be a bear market. Everyone would be prepared for it. So, but my takeaway is be prepared. It could be a couple of years, but it's unlikely that it's going to last for 3, 4, 5, 6 years. And so far, we can also take some solace in the fact that every bear market we've ever had has ended. So.
We'll go ahead and field one more question. We have a lot of attendees who appear interested in the energy sector. And one question that came in is, are oil rig and service companies doing better than the oil companies? And what is the prospect of the oil rig and service companies that you're thinking about?
Doug, do you have an answer for that? I haven't looked close enough at this sector.
Yeah.
I know in our dividend investing portfolio, we actually own EOG Resources, which is an oil production company, not on the oil service side. It's what they sound like they're asking about.
Yeah. Yep, I'm not a specialist in this particular industry at all. I know just enough to be dangerous, so I would not want to share any particular thoughts in this area. But again, this is, to me, this line of questioning is like, um, the affliction of investing in memes and YOLO and FOMO, and the jumping on the bandwagon, or trying to react to trends uh, uh, in what you perceive as real time, but real time has already happened for the pros who are out there trading. And so for us as individual investors who are not tied to our computers, 14 hours of every day, looking at the Bloomberg terminal and dissecting all of the minutia moves of the market, and trying to get an edge. Our edge as individual investors comes from not trying to play those trends, but being contrarian, by focusing on stocks that the major investors are not looking at. Uh, and this is the same reaction I have every time I'm on Reddit and somebody says, "Oh, who are the big lithium producers?" Because I hear the lithium is hot and we should get into lithium stocks. But no, if you've heard that they're hot, it's already too late to really profit in that multi-1,000% way that you are envisioning by asking this particular question. And again, my approach is, you build your portfolio, and I'm reminded, years ago when Barack Obama was president, he did a interview on a podcast, and said, running the country is like driving a tanker across the ocean. If you want to make a left turn, you got to plan way in advance, and the best you can do is 3% at a time, and that is a significant change. And to make a complete left turn takes a lot of time, a lot of resources, a lot of energy, and it's just not something that is very feasible to do. And so for me, that's the same thing about portfolio management. You set your course, you make small adjustments as needed. You don't say, "Oh, this week let's try being a trader and see how it goes for a week, and then skip on to some other tactic." No, your best course of action, I think, is plotting the course, staying the course, and keeping calm all the way through every segment of the market.
Yeah, I'll also add one thing to it. I mean, when you also want, it's helpful just to think about what's going on at the macro level. We've seen oil prices go up temporarily, but it's not staying at that level, at least not, well, I'm sorry, it has not come to the point where it's sticky. And so if you're an oil producer, it requires a lot of effort, it requires a lot of faith that oil prices are going to remain high before you start opening more wells. So you go down the line to the oil service companies, for them to get more work, it requires for the oil companies themselves to be convinced oil prices are going to stay high. And so you've got a lot of moving parts, and you start thinking, well, oil prices are going to go high. You have to start lining up a lot of ducks and hope they stay in that line. And as Doug's pointing out, the pros are analyzing data that we do not even have access to. And so that's who you're playing against.
Okay.
Excellent.
Well, thank you. I certainly learned a lot, and I'm sure our attendees did as well.
Yes, most definitely. First off, I want to thank both, Doug and Charles for discussing how to react to global conflict and what actions to take to minimize risk. And then also a special thank you to Susie behind the scenes and Cynthia for acting as moderator for tonight. We appreciate the entire team. But before we wrap up and then I share some important information and special offers, I'd like to give you, Charles and Doug, a few minutes or a few seconds for some closing thoughts that you want to share with the audience.
Sure. I think one thing in here, just remember you're investing for a lifetime. One of the great things about being an individual investor, is that you never have to report your performance. And well, you might have to tell your spouse, and I'm not going to get involved between you and anybody's spouses. That's, but what I will say though is that you never have to report your performance. And the reason why I say that is that gives you the ability to think long-term, invest long-term, approach your portfolio long-term. The professional money managers, they often get judged on their performance over a 3-year period. And if you think that I'm making this up or I'm trying to downplay them, I've been in conferences where I've seen professional investors, professional money managers say to the speaker, I agree with everything you're saying about the strategy, but it's a long-term strategy. My clients do not have the patience for me to stick with that strategy. Even though I agree with you that's going to work over the long term, I can't do that. As individual investors, we know what works well over the long term, and we have the ability to stick with it because at the end of the day, we're investing for our lifetimes. Maybe we're investing to leave a legacy to our family. Maybe it's charities you want to support, but we're playing a very different game than the professionals. And that gives us an edge if we play that game in terms of being a long-term investor versus trying to go after the short-term returns, which is what the professionals have to do because they're judged always on short-term performance.
Similarly, I like to describe Wall Street analysts and money managers and their definition of long-term. When you say long-term to your typical Wall Street analyst, they're thinking about dinner, because their time frame is very different from our time frame. But again, that's what gives individual investors the edge. And you need to learn to parse the opinions and research reports that are being delivered by the Wall Street machine, which are not always intended to make money for us individual investors out in the marketplace. So knee-jerk responses are never enriching. And again, coming back to that strategy and focusing on that long-term approach. And yeah, I like that, Charles. Every mutual fund on a 6-month and a 1-year basis is reporting its performance and how it's doing to its benchmark, and that leads to very bad behavior of window dressing at the end of the year, where these losing stocks get dumped so they don't get reported as being owned when the funds are reporting to the SEC and to shareholders. And we're free of those obligations, and so we can act accordingly. But it's our belief that the tools that AAII and Better Investing offer are really here for those individuals who want to improve their investing skills, their stock analysis, their portfolio management, understanding ETFs and their position in a portfolio, building out that lifetime investing strategy, and coming out ahead. When we talk about wealth in the country, I like the book, 20 years ago, the Millionaire Next Door, that talked about the attributes of millionaires, where the most popular vehicle driven by millionaires in the U.S. at the time was the F-150 pickup. Well, was the most popular vehicle in the country. The most popular wristwatch among millionaires brand was Timex, not Rolex. And it's a matter of perception. It's a matter of perspective. It's a matter of understanding what wealth truly is, and how investing in stocks can get you there is the bread and butter that makes AAII and Better Investing such vibrant organizations today.
Excellent. Those are great takeaways. I appreciate it. And if you have any questions about the content that you heard during tonight's event, or if you want any questions about AI's tools or services, you can either email AAII by emailing us at members@aaii.com, or you can always give us a call, leave a voicemail, 312-676-4307, Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then if you on the other side, if you have questions for Better Investing, or any of the newsletters, tools that they offer, please direct your questions to service@betterinvesting.org, or you can call them at 877-275-6242. And now, thank you so much, Charles, for sharing your screen. We have 2 special offers for new subscribers. So AAII is offering our AAII Plus subscription, which is all of our A Plus investor stocks and fund and ETF tools, plus regular AI membership for $97 for 1 year. Regularly is priced $199. And then we also have our ultimate kind of investor toolkit that gives you access to all of our model portfolios, strategies, and premium tools, and that's AI Platinum. We're offering that at a very significant discount at $198 for a 1-year subscription, regularly priced at $498. And you can visit ai.com/betterinvesting. This is a special promo that we just offer AAII and Better Investing webinar attendees. And on the other side, for Better Investing, they're offering their Better Investing membership, which is $99 for 1-year membership, regularly priced at $145. And all you have to do is use the promo code AAII at checkout when you visit betterinvesting.org/AAII. They also have their newsletters, such as the Small Cap Informer, listed on that URL as well. So you can find all of their products listed there. And then both of these offers are listed as handouts in the materials section of your GoToWebinar control panel, but we'll also include them in our follow-up email that'll go out later this week. So our next partnered webinar with Better Investing will take place on Tuesday, May 26th at 7:30 p.m. Central. So please keep an eye on your email inbox for registration information. The topic will be announced as we get closer to the event. And then also, I wanted to share that we're hosting a fun, free-to-play stock bracket challenge over the next 4 weeks. This is a first time for AAII, and all brackets close tomorrow, March 25th. Basically, we selected 16 stocks based on the most followed stocks by AAII members, and you get to pick the winner. First place wins AAII Platinum for life, with prizes for second and third place as well. And anybody can participate. And so if you'd like to submit a bracket for tonight before the deadline, you can visit stockmadness.io. And I put that in the chat, but we'll also I'll try to put it in the chat one more time. But if you can copy it and then put it in your browser. You can also use AI Plus tools or Better Investing tools to analyze all 16 stocks before making your picks. And then brackets close tomorrow, like I said, and the first round's winners will be announced on April 1st after market close. And like I said, this is just a free to play kind of fun March Madness style event or challenge. So you can invite your friends or just participate. So we're running that for the next couple weeks, so stay tuned. And lastly, this presentation was recorded and a replay will be available at aaii.com/webinars later this week. We got this question quite a lot, so I want to make sure I reiterate to all of our webinar attendees. You'll also receive an email with the link to the recording and other resources such as the presentation slides, anything that we think might be helpful, especially on this more complex topic. So please keep an eye on your inboxes for, in the next few days, probably later this week when we'll send out that email. And with that, we wish all of you viewing good health, good fortune, and a great rest of your evening. Thank you so much for attending, and take care.